Welcome to TheoTrade. This is Don Kaufman. It's November 28th, 2018, and you are watching the TheoTrade evening video on a ripping rally trading session. There's about 12 minutes left in the trading day. The S&Ps are up just shy of 60 points, which amounts to about 2%. Nasdaq rallying by a tune of about 3%. You know, call it coincidence, call it Jerome Powell, call it the Fed, call it anything you want. The marketplace has been sold off recently and sold off hard. Today, we have this kind of quintessential rip your face off rally in play. But what is imperative to understand, and an area of real focus, okay, the gravity points are holding. For those of you that are kind of tuned in, turned on for a decent period of time, we've been talking about very specific levels. One of those levels happens to be down below on your screen, and that happens to be 2682. Now you can see the low, which I just highlighted here. That was the overnight low in the session, literally was 1 point off of the gravity point. The upper gravity point that we're hitting happens to be 2731. Now, again, these are not levels. If this is like the first time you've tuned in, these aren't levels that we brought up yesterday. These are levels we've actually been looking at since the January timeframe. Levels, okay, that we've been talking about extensively, that in the midst of volatility, all we're doing right now is simply pinging, okay, between these effective levels. And when I say pinging, I mean just that, like a ping pong ball back and forth, okay, between, again, these effective levels. So we started the day, okay, just under 2682. We're going to end the day just north of 2731. You know, one thing I will display to you, if you take a look even at the 1 minute here, we've actually broken now from the 2731 gravity point. And again, if there's any question as to the effectiveness of that gravity point, just take a look at it. I mean, for the most part, Jerome Powell comments came out. We exploded higher. We exploded right to the gravity point. We sat on that gravity point for a period of 2 hours. We've taken off to the upside, but, you know, no doubt the marketplace has a pretty good chance, even in the after hours here, of reverting right back down to the 2731. So again, most of this rip and rally happened to be the comments of the Fed, which maybe, just maybe, Jerome Powell softened his tone a little bit on raising interest rates. Anyway, that's how the marketplace interpreted it. I look at it in a very different way. I think this is a rally effectively because the Nasdaq specifically has been beaten down and buried lately. You know, let's get to a couple specifics on that front. You start to look at individual stocks, things like Netflix. Until today, Netflix, you know, the rest of the marketplace rallied. Netflix, nothing. It was sitting at the bottom of the barrel. Take a look at Apple. Okay, Apple, this thing hasn't had an uptick in what? In weeks. Take a look at Facebook, the exact same story. Not an uptick in weeks. Well overdue for the rip your face off rally. That's effectively what we're getting. Now, it could be a vastly different story, though, come the end of the week. Why? Well, Jerome Powell now, kick him aside. He's out of the way. Now we're going to start talking about China once again, and that's going to take front and center on the main stage for the remainder of this week. You know, one thing that really also resonates with me in this trading session happens to be the fact that, well, it's Wednesday, and look how far outside of the expected move we are. At this point in time, this is where you got to revert back to what we talked about this past weekend. This past weekend, I said, once again, this volatility looks inherently low versus the capacity for the marketplace to move. And exactly one of the things I was pointing out, the volatility for the entire week, okay? That when I'm talking about the volatility for the week, I'm talking about the expected move. The expected move for the entire week was effectively, okay, $62. And again, I want to reiterate this, $62. So we're expecting a move $62 higher or $62 lower. That was for the entire week. We just did that today. All right, where's your $62? We've now exploded outside of what was expected by a long shot here. Now, that doesn't mean by the end of the week we can't come back into it again. Really important to kind of delineate the edge of the expected move in the SPX is 2694. Okay, listen, that alone is a tremendous amount to think about because we are way outside the expected move and it's causing firms to have to hedge, okay, in the direction. It's dynamic hedging. That is, the further we move up, the further these firms have to turn around and buy and actually force markets even higher. So you start to get this kind of squeeze to the upside. Now, another thing I want to actually focus on happens to be the VIX, or volatility in general. Now, I don't look a tremendous amount at the VIX itself. I look much more at the structure of volatility. The bottom line, though, with the VIX, it's not dropping. You're like, oh, but it dropped. But it's not dropping. Okay, this is an explosive 2% rally, and everybody just shrugged their shoulders. And you better understand what that effectively means. It means can't trust these S&Ps as far as you can throw them. We're still in the midst of volatility. We're having a record number of north of 1% moves this particular quarter. We're in the fourth quarter right now, and we're way above average of the number of 1% moves that we've had inside of the S&P 500. Today, look at this, 2% move. Listen, with a 2% move to the upside, you'd think that volatility would get absolutely crushed, annihilated to the downside. It's not. For those of you that speak absolute market geek, what I'm saying is this is the volatility structure right now. Okay? This is what the volatility structure over here, this is what it looked like right there. And that happens to be back in August. In fact, if you want to take a look specifically at my curves, that's August 1st. That's what the volatility looked like. Okay? Currently and presently, what does volatility look like? Well, presently, volatility looks like, well, it's almost flat. Even with today's 60-point rally, what that effectively means is the risk right now is relatively similar to the risk even out like 200 days from now. That almost doesn't make sense when you start to think about it. You're like, what? What does it mean? It means, again, we rallied, nobody's buying it. When I say nobody's buying it, yeah, obviously people are buying the market, but nobody's buying that the rally is going to be persistent. And that is an incredibly important factor in making trading decisions moving forward. Now, with that, I'm going to completely switch gears. I want to bring you into a trade and a trade opportunity right here, right now. It's something that I actually executed today. It happened to be in Tesla. All right, there's one thing that I'm trying to get back into, and that happens to be premium selling. There are traders that just believe that premium selling is the way to go every day, every way, shape, or form. I'm not one of them. Okay, the conditions have to be right for premium selling, and they're going to show you good conditions and not so good conditions. One of the easiest ways to do that. So I went out today and I sold call spreads inside of Tesla. And again, just want you guys to know on this evening's video, I'm ramping it up. This is kind of a no holds barred like video. And by that, I mean, I'm going to really ramp up the learning curve for you. So if you're a little bit confused, great. Tune into TheoTrade, into the chat room. We will get you straightened out. But I think this is incredibly important today's session. I went out and I sold, and you can actually see my positions in here. I sold the 390s and bought the 395s. Again, right? What does that position amount to? I sold that little monkey right there, okay? And I turned around and I bought the 395s against it, okay? So again, sold these, bought these. I did the trade I actually filled today for right around $1.30 credit. So executed a couple of contracts right for about $1.30 credit. Great. Listen, you can analyze this thing until, you know, your heart's content, whatever does it for you. But the analysis isn't about like, okay, so why did I sell premium? Why does it seem advantageous to sell premium? My selling premium of the 390, 395 wasn't about being bearish, right? Okay. The marketplace right now on Tesla is right here. The mid kind of 350 range. I'm fine as long as we don't come up to like 390 and above. That's going to start to get a little bit scary. Let me show you why I sold premium. As I said, some people are just diehard. Oh, I'll sell premium into anything. If you take a look at option statistics and you look at what's called the IV percentile, well, it doesn't look too advantageous. It's a 39th, ranking in here. So what that effectively means is we're actually lower volatility. But this is actually not a percentile, even though it says percentile. It's really more of a ranking. Let me show you why it's advantageous right now to sell premium inside of Tesla. So I'm going to cruise over to style. And one of the styles I have set up has IV rank and percentile for a year. Okay, so I'm just going to snap out in a longer period of time to just show you for a second. Look, Tesla, it hasn't ever really been above the 389 level. So I figured I'd sell a 390, 395, and yeah, Tesla would have to hit an all-time high for me to really lose money. But that's, again, it's not the reasoning I did this. So that's why I wanted to show you the 3 years. Snap it back down to 1 year. Okay, on a 1 year basis, if you look at what's called IV rank, it's about that 39%. But if you look at what's called IV percentile, this is a true percentile. This is a script, okay, that we have had written for us here at TheoTrade. And what it effectively says is, volatility has backed off inside of Tesla, but it's still in the 60th percentile, which effectively means like, hey, listen, still a decent time to be able to sell premium. But the other factor that I really want you to take into account, now we're going to go to studies, and we're going to go to add study. We're going to go volatility studies, and I'm going to drop in there historical volatility. Historical volatility is actual stock price movement. Here's the bottom line. Okay, actual stock price movement over the last, we'll say averaged over the last 20 days. So actual price movement is about 40%. But the implied volatility inside of Tesla right here, right now, the implied volatility 51 days out is paying me a rate at about 64%. Even in the short duration, let's say 20 days out, is 61%. Now, look, historical volatility is backward looking. Like when I say it's backward looking, this is how fast, or how much the stock was moving, over the last 20 days. This, okay, which is implied volatility, and let's look at implied volatility. Implied volatility is forward looking. Implied volatility is looking out, for example, the next 30 days. Okay, but the bottom line over here is the implied volatility. The implied volatility is paying you really well. It's paying you at a rate of like 60% when effectively, okay, the actual price movement has been considerably below that 60%. And that becomes advantageous. There's edge in there, right? There's edge because the implied volatility is exceeding, okay, actual stock price movement. It doesn't necessarily mean we're going to be right. Now, let me show you what doesn't work, okay? What doesn't work if you look at something like Amazon, okay? Amazon, what's wrong in Amazon, okay? There's the closing bell. Well, in Amazon, the exact opposite conditions exist. Amazon has about a 37% implied volatility. Actual price movement, though, is north of 52%. And again, you can't make this stuff up. Just look at the historical volatility versus the implied volatility. Historical volatility averaged out over the previous 20 days is 52%. The implied volatility over here is about 37%. So you would be putting yourself in this huge deficit position in selling options in Amazon. And this is one of the reasons, like just looking at this IV ranking or IV percentile isn't going to do squat for you. You're going to have to get a little bit more kind of down and dirty with this marketplace to get a better feel for it. In any regard, this leaves us, okay, with the idea of selling this call spread. We're going to be looking for a lot more of these opportunities. Premium selling opportunities, well, they're starting to open up through and through. You're just going to have to be, again, a little bit more effective in your stance to be able to find some of those opportunities. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.